Hello, everyone, and welcome back to the show. We are glad you are here.
It is great to be here,
You're on the Smart Capital School channel.
and we've got a big one today.
Oh, we do. I drove past a dealership this morning, saw the whole setup, the giant inflatable gorilla, the balloons, banners screaming, "Zero down."
The usual.
And I had this sudden realization that's not a car lot, it's a wealth extraction facility.
That is a cynical, but I'd say entirely accurate way to start this deep dive.
We have to be cynical today. We're diving into the absolute financial minefield that is getting a car in 2026.
Minefield is the right word.
I mean it. One wrong step, and we're talking about the difference between buying and leasing, can blow a massive hole in your net worth.
And the blast radius isn't just your monthly budget, it's your future. It's the compounding interest you're giving up.
That's it. We're not just talking about cars today, are we? We're talking about the opportunity cost of capital.
Exactly.
But here's the hook, and this is where most people get tripped up. Everyone gets fixated on the monthly payment.
Oh, yeah. It's the first question the dealer asks. What do you want to pay per month?
Right. And it feels like they're helping you, but focusing on that number is basically a magic trick. It's sleight of hand to distract you while your wealth just burns away.
The sticker price is an illusion. The monthly payment is a partial truth. The only metric that actually matters, the one we're going to obsess over today, is the total cost of ownership.
The whole picture. So let's set the scene for 2026. Because if you haven't looked at car prices lately, you might want to brace yourself.
It is grim. As of right now, the average new car payment in America is over $750 a month.
$750, that's $9,000 a year. Just to have a metal box sit in your driveway.
That was a mortgage payment not that long ago in some places.
It was. And the terrifying part, that $750 is just the entry fee. That's before gas, before insurance.
Before a single oil change.
Yeah.
And the average new car price itself.
Right around $50,000. 50 grand. So our mission today is pretty simple, but it's also pretty brutal. We're running a side-by-side mathematical page match, buying versus leasing.
6 years. We're going to see which one builds wealth and which one just sets your cash on fire.
And to do this right, we have to compare apples to apples.
Yes. We can't compare buying some old beater to leasing a brand new luxury sedan. That's how people fool themselves.
Right. So we picked a control subject. We're using the Toyota RV4 Woodland Edition.
A very sensible, very popular choice. Perfect for this.
It is. The sticker price is $39,900, which, is about 10 grand below the national average. So we're already trying to be responsible here.
We're starting from a rational place. So let's get into the buying scenario first. We need some assumptions.
Okay, let's unpack it. We're assuming a prime credit score. This is a responsible buyer. They're getting a 6.51% APR.
Okay.
They're putting down 20%, which comes to $7,980. And they're taking a standard 72-month loan, 6 years.
Very standard terms. So what's the monthly damage?
The monthly payment comes out to $537. Over the 6 years, total loan payments are $38,664. And honestly, that $537 compared to the $750 average, it feels like a win.
And that is the trap. You see $537 and you think, I can do that. I can squeeze that in. But let's look under the hood of that loan.
Okay.
You said the total payments are over $38,000. Here's the depressing part. Of that amount, $6,744 is purely interest.
Ouch. Almost 7 grand.
Let's just pause on that number. That isn't a fee. It's the cost of impatience. In the first year of that loan, because of amortization, you're barely touching the principal. You're mostly just paying the bank's profit.
It's why trading in a car after just a couple years is financial suicide.
Totally. You haven't built any equity. That $6,700 buys you no car, no gas, no nothing. It's just rent on the money.
That really puts it in perspective. It just evaporates. But the bleeding doesn't stop there.
A car doesn't run on hopes and dreams.
We have to factor in the hidden costs, the real budget busters people forget about on the showroom floor.
Insurance, fuel, maintenance.
And we've got the numbers. Insurance is estimated at about $8,640 over the 6 years. Fuel, assuming you actually drive it, is coming in at nearly $12,000, about $165 a month.
And maintenance. Even on a super reliable Toyota, you've got tires, brakes, fluids. Over 6 years, you're looking at around $7,272.
So you add up the down payment, the loan payments, insurance, gas, maintenance. It's a huge pile of cash. Buying has a secret weapon, doesn't it?
It does. And this is the saving grace. It's the asset value.
Right.
That RB4 holds its value incredibly well. After 6 years, this car retains about 68% of its value. That means at the end of it all, you own something worth $27,430.
Okay, so let's get to the final number. We take all the cash we paid out, every single penny, and we subtract that resale value. What's the damage?
The total cost to own over 6 years is $47,033.
Which breaks down to about $7,839 per year.
Now, $47,000 to own a $40,000 car for 6 years. It's not great. You paid a premium. But imagine if you'd picked a car with poor resale value.
The depreciation trap.
Exactly. Say you'd only retained 47% instead of 68%. That total cost would balloon to over $55,000. The specific car you buy is critical.
Okay, so $47,033. That's the number to beat. Let's bring in the challenger. Leasing.
All right, now people love leasing. It feels modern, flexible. But to be fair, since we did a 6-year buy, we have to look at 2 back-to-back 3-year leases.
Right, so you lease one, drive it for 3 years, give it back, and then immediately lease a brand new one for another 3.
Exactly. Now, we should explain what's happening when you lease. You're not just renting. You are paying for the car's depreciation over that time, plus a finance charge, they call it a rent charge, plus taxes and fees.
I feel like that rent charge is something they just gloss over. They say money factor and hope your eyes glaze over.
Oh, they absolutely gloss over it. It's like this. You're paying interest on the entire value of the car, even the part you'll never own. You're paying interest on the residual value.
So you're financing the whole pizza, but only eating the crust.
That's a great way to put it. So let's look at the parameters for leasing. We're assuming a down payment of $3,750 per lease. So that's $7,500 total out of pocket over the 6 years.
Okay.
And here is the seduction of leasing, the monthly payment. In our scenario, it's $450 a month.
See, I have to play devil's advocate here. That's lower than the buying payment of $537. That's an $87 difference every month. For a family on a tight budget, that's real money.
It is, and cash flow is oxygen. I get it. But you have to ask yourself, is that $87 savings real, or is it a loan from your future self?
What do you mean?
Well, you save $87 now, but you are guaranteeing you will have a car payment forever.
That's a fair point. So over 6 years, the total lease payments come to $32,400.
And your insurance and fuel costs, they'll stay the same as buying, but you get one big advantage.
Maintenance, right?
Correct. You're always in a new car, always under warranty. So we're setting the maintenance cost to 0.
Okay, so let's stack it up. Cheaper monthly payment, 0 maintenance, new car smell every 3 years. This is starting to sound pretty good.
I know, but I have a feeling you're about to ruin the party with the final tally.
I am. Let's look at the final number. When you add up the down payments, the monthly payments, the insurance, and the fuel, the total cost to own for leasing is $60,420.
Whoa, $60,000.
That's $10,070 per year.
So wait, let's compare. Buying was around $47,000. Leasing is $60,000.
The verdict is clear. Leasing costs you $2,231 more every single year. Over the full 6 years, buying saves you $13,386.
That is the price of a decent used car. That's a huge, huge difference.
It is, but it's not just that you save 13 grand. It's what that 13 grand could be doing if you invested it instead of sending it to a dealership.
You're preserving capital. And there's an even bigger point we haven't hit hard enough yet. At the end of the 6 years of leasing, what do you have?
You have an empty driveway.
Exactly. 0 assets. You hand back the keys. In the buying scenario, you have a RAV4 worth $27,000. That's the wealth builder. You have equity. The lessee has nothing.
It seems like an open and shut case then. Buy wins, lease loses. But life isn't a perfect spreadsheet.
There are always variables, and this is where it gets nuanced. There are 3 big traps that can change this math.
Okay, trap number 1, the short-termer. What if I only want the car for 3 years? Does leasing win then?
You would think so, but for the RAV4, no. Buying is still cheaper. It saves you about $5,445.
Why? Is it that resale value again?
It's entirely the resale value. The RAV4 keeps 81% of its value at the 3-year mark. It's absurdly high. So the depreciation you suffer as an owner is very low. However,
Here comes the twist.
if you choose a car with bad resale value, say a luxury sedan that drops to 60% after 3 years, then leasing actually becomes cheaper by about $3,000.
That is fascinating. So if you're going to drive a car that panks in value, you might as well let the dealership take that hit.
Precisely. You're outsourcing the depreciation risk. So if you swap cars often, you have to check that specific car's depreciation curve. It changes everything.
Okay, trap number 2, the high mileage driver.
Ah, yes. This is where leasing goes from being expensive to being predatory. Standard leases cap you at 10,000, maybe 12,000 miles a year.
And if you go over,
The fees are steep. 15 to 25 cents per mile. So let's say you drive 18,000 miles a year. Not crazy.
No, that's a normal commute plus road trips.
That's 6,000 excess miles a year. At 25 cents a mile, you're looking at $4,500 in fees over the lease. Over 6 years, that's $9,000 in extra fees.
So leasing becomes disastrously expensive.
Yeah. If you drive a lot, do not lease. It's a trap.
And finally, trap number 3, interest rates. We used 6.51%. What if rates drop to, say, 4.5%?
If rates drop, buying gets even more attractive. You'd save another $2,000 or so, and you can refinance a loan. You can't refinance a lease.
And if they spike to, say,
And
8.5%?
our monthly payment balloons, which hurts. But buying usually still wins out because you own the asset at the end. That equity typically outweighs the higher interest cost.
So we've crunched the numbers. The math says buy. But I know that sometimes we don't make decisions based purely on a spreadsheet.
We have to acknowledge the human element. There are valid reasons to lease, even if they cost more. We're not robots.
So let's run through them. First up, business owners.
This is a big one. If you can write off the lease payment as a business expense, the tax savings can really offset that higher cost. It's a clean line item.
What about the image professionals?
Think realtors, high-end consultants. If your job depends on projecting success, a brand new car every 3 years might actually be a marketing expense, not a luxury.
And then there's just peace of mind.
Some people just never ever want to deal with a mechanic. They want to pay for the privilege of never worrying about a transmission repair.
And that's fair. We were looking at that Morgan Housel piece, The Art of Spending Money. It basically says our values are shaped by our upbringing. If you value convenience above all else, it's okay to pay for it.
Absolutely. But the key phrase here is with eyes open. If you lease because you think it's cheaper, you are being fooled. But if you lease knowing it costs $13,000 more, but you decide that convenience is worth that to you, well, that's a valid lifestyle choice.
I love that distinction. Know the price tag. Don't let the dealer tell you the price tag. So let's pivot to the finale. This is the Smart Capital School. What's the ultimate wealth building strategy?
The golden rule has 2 levels. Option A, pay cash.
Cash is king.
Think about it. With interest rates around 6.5%, paying cash is like getting a guaranteed 6.5% return by avoiding the interest. That rivals the stock market, but without any of the risk.
That's a great way to frame it. But for most people, dropping 40 grand cash isn't an option. So option B.
If you must finance, you follow a strict protocol. First, buy a reliable car with high resale value. Second, take the shortest loan you can afford. And third, this is the most important part, drive it into the ground.
Drive it till the wheels fall off.
The real savings, the wealth building, happens in years 7 through 12.
Because the payment is gone.
The payment is gone. Your cost per year drops like a rock. You're driving a paid-off asset. You've just eliminated one of the biggest lines in your budget.
And this leads to the investment hack. This is my favorite part. This is how you actually get ahead.
Right. Once that car is paid off, you've been used to paying $537 a month. Don't absorb that back into your lifestyle.
Don't just spend it.
Take that $537 and set up an auto transfer to an investment account. Redirect the cash flow from a liability to an asset.
So play that out. If I take that $537 and put it in an index fund for the next 6 years while I keep driving my paid-off RV4, what does that look like?
That's how you turn a car purchase into a retirement fund. That $537 a month, compounding at 8 or 10%, turns into $50,000 or $60,000. That is the opportunity cost of leasing.
So to recap, buying generally beats leasing by a landslide, about 13 grand over 6 years, unless you pick a terrible car or have very specific business needs.
The sticker price is irrelevant. The monthly payment is a distraction. Resale value is the secret weapon.
And as we close out, here's a provocative thought for you to mull over.
Right.
We all love the smell of a new car. It's intoxicating.
They literally bottle it to trick you.
They do. But ask yourself, how much of your future wealth are you trading for that smell every 3 years?
Is the convenience of a lease worth delaying your retirement by a year or two?
Yeah.
Because that's the scale of money we're talking about when it's compounded over a lifetime.
Something to think about next time you see that inflatable gorilla. Subscribe to the channel, like it, and see you in the next analysis.
Goodbye, everyone.